3 weeks ago, I talked about the market crash. I talked about using fear barometer that we saw the market was kind of overpriced. And it was the time when the correction would first kick in. And since then, the market, the S&P 500 has been correcting about 3%. And people are asking me, Rain, where the market goes tomorrow. And well, I tell you that I do not predict the markets, but I would say that there are some interesting points that are worth kind of considering, which tell you that likely the market will continue for further corrections. Last week, market were talking about two important data. They are CPI and PPI. And let me explain to you why these two numbers are important. First, CPI is the Consumer Price Index, which measures the average change in prices paid by consumers for a basket of goods and services over time. And we use this number, or we call it indicator, to measure the inflations, the current inflations. Whereas for PPI, it stands for Producer Price Index. This measures the average change in prices received by domestic producers for their output. And PPI is also used to measure the current inflations. So the difference between this PPI and CPI is PPI is used to measure prices from producer perspective, while the CPI measure the prices from consumer perspective. So when there is an increase in price, well, PPI measures wholesale inflations, while the CPI measures retail inflations. Well, what happened with these two data last week was the July CPI was 3.2%, which is up from 2.9% in June, and the July PPI was 0.8%, which is up from 0.5% in June. And this report caused mixed reactions in the market. While the CPI is slightly below expectations, which is 3.3%, and the PPI is apparently over expectations, which is 0.7%. Now, why these two numbers are so important for investors? Well, these two numbers are the indicators that determine whether or not Federal Reserve is taking action to continue raising the interest rate to cool down inflation in the next FOMC meeting in September. Well, the prevalent belief among many investors is that when inflation is down, Fed stops hiking the interest rate, the case is solved, then the market starts to climb back up. And now, probably after hearing that, you are ready to deploy your cash, ready to make money in the stock market. But if you really want to do that, please hear me out first, because probably I would say that this will not be the case here. Despite I probably agree with you that we are not that far from stopping the interest rate hike. And let me explain to you the reason why. Now, when you look back at the chart and track back the history of the market since 1997, the market exhibited periods of stagnations. And on the years of 2000 and 2007, the market formed its peak. And early after the correction in 2009, the market started to rally up. Then by 2013, the market successfully crossed over the peak and continued to rally. Now, if you look at the long-term 30-year Treasury notes, it was only when the yield dropped to approximately about 3% in 2013 that a noticeable upswing in the stock market became apparent. And for the 10-year Treasury notes, it's evident that it was only when the average yield reached around 2% then this propels the growth. Today, probably you are looking at considerably elevated 10-year and 30 years yields, which are hovering around 4.3, 4.4, and 4.5%. And drawing insight from historical trends, it is quite evident to say that reducing interest rate is so important to promote the market growth. So there are actually two things that investors are kind of waiting for. First, when the Fed really decides to stop raising the interest rate. And second, which is more important ones, is when Fed is going to cut the interest rate back. Well, today I believe that it is hardly possible for Fed to cut the rate for now in the near term, or at the very least, probably earliest around Q1, Q2 next year, 2024. And this is precisely where the complication arises. Now, looking at the long-term rate ranging around 4.3 to 4.5% return as a risk-free return, I would say it is undeniably an enticing opportunity. And according to several studies, including Forbes, indicates that investors generally just anticipate around 7% return just to motivate them to participate in the stock markets, given that historical average return for stock market is just about 9% or about 10% per year. So I would say that from logical standpoint, investors are rather beating their time for now for the yield to stabilize first, because then they can enjoy the optimum and absolute high return without any risk. Imagine that by getting around 4.3 or 4.4%, which is about 65% return from their anticipated market return without taking up any risk, that is high. And remember that when one asset is relatively overpriced, which is the stock market, I would say there will be another opportunity in the markets. And I would say that's probably the obligations. So with this opportunity, investors are really inclined to secure their investment in, extended or even in the just short-term kind of commitments. Right now, just take a look at 2-year notes. It yields about 5%, and that's about 71% to their anticipated market returns. So this investing opportunity to obligation, I would say, will bring down the support level of the stock markets, which you will see later how this will impact the stock markets. And another aspect that deserve your attention is the predominant factors that's steering the 2023 stock market, which is the rise of artificial intelligence. I would say that many investors hold very strong convictions that the AI will change the world, creates a new and novel products, enhances operational efficiency, and makes better decisions almost in everything. So you will hear many stories of either companies developing AI or just making use of the AI. Now, let's examine the performance of those stock drivers throughout the current year. Here we have the Nvidia that has surged by more than 200% year to date. The Alphabet, known as Google, it's up more than 40% year to date. Microsoft is up for more than 30% year to date. Adobe is up more than 50% year to date. And here we have AMD, it's also up more than 65% year to date. Tesla is up and over more than 100%. And Meta is up more than 130% year to date. And Nasdaq 100 is up more than 35% year to date. So they are the one that really have been driving the entire market to be bullish. The surge in these AI-related stocks has been really is the driving force behind the overall upward momentum of the markets. Nevertheless, investors frequently overlook the fact that development and training of artificial intelligence demands a significant amount of time. So we can't just immediately deploy the AI in many sectors in the hope to boost up productivity and efficiency. Furthermore, there is a possibility that certain companies could propagate fake AI narrative in the market just to artificially bolster the confidence. So whatever upside that you see in the market today is the outcome of pre-merger AI benefit speculations. So the question is, what's going to happen with the market now? Well, if we examine the Nasdaq 100 index, it has just recently dipped below the 50 moving average. So the market driver seems losing its momentum, and this could lead to a forthcoming corrections in the market, including the S&P 500. Now, by looking at the trend channels, it might first correct at the 4,200 level. However, given the high yield environment today that we have, if the market believes that the Federal Reserve is putting a stop to its plan for raising interest rates further, this, I would say, could exert additional downward pressure on the support level. So maybe around the 4,000 or 3,800 level. So this scenario could go against the prevailing belief of many investors. So in general, this August or September could be a profit-taking season. And my message is that you just probably would like to be extra careful in this coming month.